The final module in Chapter 12 is related to implied volatility, which is a term you often hear in discussion about the derivative markets and options in particular. This point keeps coming up, that volatility is unobservable because it's a prospective measure. Volatility meaning volatility for options. The sigma that we need for options is unobservable because it's a prospective measure of stock price volatility. While volatility is unobservable, choosing volatility for the pricing of an option is an important exercise because we have seen how important sigma is in the determination of volatility prices, in the determination of option prices, that is. We've seen this in the Black-Scholes formula where the sigma measure weighs prominently in that formula. We've also seen its effect in the binomial lattices and the binomial trees that we've developed where sigma is an important part of the resulting distribution of stock prices. So we know that sigma is an important measure despite the fact that it's unobservable and it's difficult to choose. It's an important decision that has to be made. And one of the important approaches is the analysis of historical volatility, namely looking in situations, for example, an S&P 500 option, one might look at historical S&P and again look at the range of volatility over various periods of time, trying to determine what would be an appropriate measure given the economic environment that we're currently in. Is there a prior economic environment that looked reasonably similar that we might use and say the historical measure during that period might be appropriate today? Of course, in the future, the stock market and the economics of the market can change very quickly, and that's a risk the investor takes. Alternatively, we can what's called invert a Black-Scholes formula to obtain an implied volatility. And what the idea is here is that, let's say that we're interested in pricing an option on a high-tech company stock, and we observe that the market is trading an option on a close competitor's, which is again a high-tech company, and we can look at trading in that option. We might then look at the Black-Scholes formula, and every parameter of the Black-Scholes formula is observable. We can look at the assumed dividend rate, the risk-free rate, the strike price, the stock price, and the only unknown in that formula would be sigma. And we can determine what value of sigma is the market assuming for that high-tech competitor firm in order to be selling its options. That's what's called implied volatility. It's reverse engineering the price of an option and determining what value of sigma would be used in the Black-Scholes formula in order to reproduce the price that one observes in the market. So the volatility, so the implied option, the implied volatility from an option, we can use it, and the question then becomes, how do you determine which volatilities to use with options? And again, this is a bit of a science, but also a bit of an art. If the high-tech competitor firm had experienced significantly more stock volatility historically, it might be a little bit dangerous to assume that that's the appropriate price volatility. So this is perhaps more art than science, but we need to check the uniformity of implied volatilities across options. So very often what market observers do is evaluate implied volatilities of options on different sectors of stock market, perhaps different indexes, different terms, and tries to understand generally how the market is pricing future volatility in different situations. But which of those estimates is most appropriate in the situation that we're trying to price is again a bit of an art. An interesting phenomenon that is theoretically inconsistent with the Black-Scholes model is that the market trades volatilities as a function of the strike price. Namely, that when one looks at, let's say for a fixed term, options on a given index or a given stock, fixed the term, say 3 months, and you compare the implied volatility of an in-the-money option, at-the-money option, and out-of-the-money option. In general, when you graph that volatility as a function of the strike price, you'll find that the volatilities are not constant. Now, the Black-Scholes formula, interestingly, does not allow sigma to vary with k. There's nothing in the Black-Scholes formula that prevents sigma from depending on t. Nothing at all. That it's perfectly fine to have the 9-month sigma different than the 3-month sigma or the 6-month sigma. But there's nothing in that formula where logically sigma ought to depend on k. And, namely that for a fixed term, a 3-month option, whether the strike price is 30 or the strike price is 50, the volatility ought to be the same for the stock. But one finds that there is a so-called volatility skew, and that is to say that volatility for a given t, volatility is not a constant function of strike. In general, the implied volatilities of puts and calls with the same strike and expiration have to be the same. So you can't have put and call volatilities different. In general, even though there may be a dependence on the strike price, the dependence for puts has to be the same as the dependence for calls, because put-call parity still has to prevail.